Welcome to Yield Nerd, an educational show about how you can acquire and manage yield. Introducing the Yield Super Bowl. This is no ordinary event. In the blue corner, we have the federal and the agency bonds. The treasury bonds and the agency bonds have been bumped up by state tax so we can get the pre-tax yield. And that is on one side, and they have George Washington on their side, and they will be playing against, in the red corner, none other than the municipal bonds, the AAA, the AA, and the A, all playing together. And in their case, we're going to bump up their yield by our current plug number of 20%, so we can understand how those two fare against each other. Let's get going. 20% federal income tax. The answer is quite clear. If the duration is less than 9 months, treasuries, hands down, are the winner. If the duration is in the middle of the fairway, the entire middle portion of the curve on a tax-adjusted pre-tax basis, if your federal income tax is 20%, agencies, again, you got to make sure it's the right agency that does give you the state and local tax breaks, but agency bonds will crush competition all the way until a duration greater than 20 years. And in that scenario, your agency bonds do win. And all of this is true if your federal tax rate is 20%. Now, what happens if you have a higher tax bracket or a lower tax bracket? So let's play with that. If your tax rate is 28%, and again, I told you my philosophy are not looking at the marginal tax rate, which is the highest number, but really looking at money going out off your credit card at the grocery store, which can't tell the difference between the first dollar and the last dollar. So at a 28% blended federal income tax, treasuries again absolutely demolish all competition with a duration less than 9 months. Agency bonds do win, but because of the higher federal income tax, municipal bonds slowly come into the picture with the duration greater than 4 years. So if you are looking at investing for a duration of more than 4 years, municipal bond tax adjusted pre-tax yield will indeed be higher for you. And so you kind of see that the time scale, the duration in which municipal bonds win, shifts to the left, or the duration becomes shorter for people in a higher tax bracket. And if you are in a 15% federal income tax bracket, good luck. You will probably not want to buy munis, no matter how much you like the concept. If you really want to support your state and your locality, perhaps, to the extent that you feel charitable, you can buy municipal bonds. But on a tax adjusted basis, you are most likely going to come out better if you bought treasuries and agencies all the way until 30 or more years. So that is the general picture that emerges from all of this analysis. If you are not in the state of Illinois, remember, we just used a plug number of 6.25%, and we used that number to bump up the federal to treasuries and agency bonds. We also did not bump down the municipal bond yields, in part because in the state of Illinois, even if you bought an in-state treasury bond, they are going to tax you. Perhaps in your home state, you do not have taxes on in-state municipal bonds. In those cases, municipal bonds will have a higher yield, and so there may be some differences in the duration at which municipal bonds become more profitable for you. And if you also are looking at the net effect, you should both take your federal tax rate and also take your in-state policy towards municipal bonds that you buy on an in-state basis to give you the combined picture. If you would like the worksheet that I used in order to construct the various curves, email me and I will send you the data behind it and the worksheet. You would then plug in your federal tax rate, your state tax rate, and you will get personalized curves. And again, remember, this is education. I'm not your tax accountant and I'm not a wealth management advisor, but it'll be a good guide for you. Now, let's get into the part where we actually buy a municipal bond. To get there, my standard disclaimers apply. I'm showing Schwab. I'm not endorsing Schwab. You will click on the research tab. And from there, you would click on bonds and fixed income. You may remember munis show up on this area here below corporates. And we'll talk about corporates and a couple of others as we go along. And for fun, we're going to pick 10-year munis. And we're going to click on one of these. And there's something interesting. You can see that the yield is the same for owning a 10-year and a 5-year. You tell me what that means to you. Some of you may say, based on my tax bracket, I may want a shorter duration muni. I may want a longer duration muni, but what a pleasant surprise. You can kind of earn the same yield and move with the duration backwards and forwards. And others may say, well, why am I going to get locked up for a greater duration if I'm getting the same yield? So there's some funky business going on there in the list of available municipal bonds, and we're going to dive deeper into that. So we're going to click on one of these, and you will see a screen that looks like this. This is a lot of data, and the first thing you're going to notice that this doesn't split it into revenue bonds and general obligations. It doesn't split it into unlimited versus limited versus general funds. You kind of have to read through all of those on your own, believe it or not. So for example, you would understand this is a revenue bond by seeing the word REV. You would understand this is a general obligation bond by noticing the word GO. There is something called an OID, which is called an original issue discount, meaning this bond originally may have been issued at a face value of $80. However, when the bond matures, the municipality will buy it back at $100. You may remember we reviewed this concept and we called it a discount in the treasury bond world. In the municipal world, we call it OID, original issue discount, where intentionally the municipality says, hey, we don't want to give it to you at $100 par value. We'll give it to you at an $80 par value. Our coupon is 2.375%. But hey, if you waited 10 years, we will buy your $80 bond for $100. And so your total yield to maturity is really that 4.788%. You're just getting it in two different chunks. And obviously, the reason why the municipality would do it that way is so they can pay a lower coupon, and yet you will, if you had the finances to wait for 10 years to get the net effective yield, your net effective yield to maturity would be 4.78%. So that's what they're doing there. It's called an original issue discount. The next thing I'm going to point out is the price. As you can see, this is the secondary market. Practically everything is trading, in a value that is not exactly par. In this case, the $100 par value is trading at 101, the $80 is trading at 81, and so on. Here is actually an original issue discount, $80 trading at 79.18. So there clearly are things that are trading below par value, some things that are trading above par value, and so on. The coupon itself has a great variation. You can see that there is the 5% coupon where the bond is trading above par, and there is the 2% coupon which is trading below par, even with the original issue discount. So that's the coupon, that concept that you're familiar with. Now, all of this you are seeing here is the secondary market. Bonds do have a primary market or an auction market. We're going to look at that in a minute. The yield to maturity and the minimum are two other things you're going to pay a lot of attention to. In other words, if you had $7,000 to spend, your choice pretty much is this Montgomery County, Texas, because that is the minimum between $5,000 and $20,000, or this one right here where the minimum is in between 5 and 20. The first one, the University of California bond, the minimum is $175,000. So you want to watch the minimum, you want to watch the yield to maturity, you want to be comfortable with GO versus revenue bonds. And so there is a lot of information packed into one screen here. You probably also want to look at the prospectus of the bond. The reason you want to look at the prospectus of the bond is the name alone may not tell you whether the bond has certain tax treatments. So if you're going to do it yourself, you really need to understand the prospectus of the bond. Pull up the document, see what it says, and then understand whether you want to buy it or not, and not just go by a couple of words here on the screen. Now, what about new issues? Here is a whole laundry list of new issues that are coming out. And as you can see, some of them have not been priced yet because they have not yet started trading. And in some cases, the auction is closed because everybody that wanted it has already bought it. In other cases, it is open. And what you're also seeing in terms of credit ratings is some of these have not been rated by S&P, others have been rated by S&P. And so there is a whole lot of information that is available in new issues. This tells you clearly whether something is federally taxable. You may remember that there are certain kinds of bonds that will be federally taxable, and the state will declare it ahead in time, and you need to be a knowledgeable investor when you buy that. Is it taxable in your state? And the simple message there is go check your state. We don't know what your state is, so go check that. Is it taxable on an alternate minimum tax basis? So all of these are individual items you sort of need to put together. And so you start from what is the state of issue? If you lived in California, this is an in-state bond. If you don't live in California, it's an out-of-state bond. So that is the first thing. The second thing is we talked about the unlimited general obligation versus the limited general obligation and the general funds and so on. So you're going to look at that. You're going to see what the tax treatment is at the federal level. Some of you may want to look at the credit ratings and understand that. And in some cases, they would tell you upfront federally taxable. They're spelling it out for you. So when you look at the yield of this bond, you want to compare it with other opportunities and see if that is something you want to go forward or not. But assuming you were to click one of those, you would get a screen that looks like this. This is an OID, or an original issue discount. Instead of $80, it is trading at 81.475. And the yield to maturity is 4.581. However, the coupon is only 2.25. What does that mean? This bond will pay you 2.25 for 10 years. And at the end of 10 years, the bond will be purchased back for $100. That is really what it's saying. So the yield to maturity of 4.581, you are trying to buy it for a price of 81.475. The coupon is 2.25%. When the bond is bought back, the par value is 100. The credit rating is a AA or a AA3, as you may see it, and it can go as high as AAA, as low as AA in the section of bonds that we are looking at. And once you click that and say, sure, I'll buy it, you are going to see what the fees are. And in municipal bonds, the fees are called markups, and every $1,000 incurs $1 in fees. So what this is doing is, because you're purchasing a par value of $10,000, the markup is $10. In addition to that, the price you're paying is $81.37. However, when it matures, it will become $10,000. And the accrued interest, you may remember we discussed this earlier as well. You should go back and watch treasuries if you've forgotten that. If you bought the bond today on October, whatever date it may be, September, whatever date it may be, the previous holder of this bond, because it's a secondary market, has already earned an interest of $1.25. You are paying the previous owner back the interest they have already earned. And when 6 months are over, because this pays semi-annually, you will get the entire amount of the interest credited to you. That is why there is an accrued interest. So what you're going to see here with the yield to maturity is that you are buying $10,000 of cash flow in 10 years for 8,148. of which $1.25 would be credited to the previous owner, and you will earn that back during the next interest payment. Your coupon every 6 months is going to be 2.25%, and when it matures, it becomes $100, and the credit rating is reasonably good. My usual disclaimers apply. You probably need to think through, do I know this locality? Do I have reason to trust this locality? Do I know people who live there? What are the geopolitical things going on? What are the geographical things going on? What is the home base? There is a lot more than just credit ratings and things like that. So get to know the municipality. See if you have reason to believe that it is a risk that you want to take. Of course, you should read credit ratings and things like that, but be an educated yield investor. Well, we're coming to the very last chunk of this. So what did we learn? We learned that we needed an Excel spreadsheet, 3 pieces of paper, your past tax returns to buy munis. We also learned that it's not all about yield to maturity. It has a lot to do with duration and your taxes when it comes to municipalities. Constructing a portfolio of laddered yields takes a little bit of work, but if you're smart and you want to invest the time, which I would say you should as a yield nerd, you can sit down and hammer it out in 10-15 minutes. You are welcome to contact me and I will get you started with the draft Excel spreadsheet. I know this took a long time to get here. I appreciate your time and your support. Let's go, yield nerds. Thank you for listening to Yield Nerd, a do-it-yourself show for yield accumulation and management.